In the hallowed halls of the U.S. House of Representatives, a crucial battle has been won. A bill to suspend the massive $31.4 trillion debt ceiling that's passed the Republican-controlled House of Representatives. The deeply divided House voted 314 to 117 to clear the bill. The bill has been passed and it will temporarily suspend the debt ceiling until the January 2025. This gives lawmakers breathing room to address the pressing issue after the 2024 presidential election. It's not just about the borrowing limits here. The bill also includes spending caps, energy project permits, work requirements for food aid programs, and of course a clawback of unused COVID-19 funds. It was not an easy decision for both the parties in the lower house of the Congress. Lawmakers from both the parties had to set aside their differences, balance their competing priorities and ideologies to pass the bill.
Tonight, we all made history because this is the biggest cut and savings this Congress has ever voted for. And it's not that we're just voting for it. This is going to be law. $2.1 trillion. Because of the vote we took tonight, the largest rescissions in American history. All the COVID money, the billions of dollars sitting out there that they said they would never bring back. You know what? To the taxpayer, to you hard-working Americans, we stood for you. We brought that money back.
This is extortion, but we have to deal with it. It's for the benefit of our country and the world's economy.
U.S. President Joe Biden hailed the passage of the bill as a critical step to prevent a devastating default. He said, and I'm quoting here, "Tonight the House took a critical step forward to prevent a first-ever default and protect our country's hard-earned and historic economic recovery." Now the bill goes to the Senate, which has a slim Democratic majority. The U.S. Senate will vote on the bill later this week before President Biden can sign it into law. Remember, the government is forecast to hit its borrowing limit on the 5th of June here.
Baldwin, Mr. Barrasso, Mr. Bennett. Make good on our promise to take on climate change and climate justice.
People on Medicare with diabetes.
And to talk more about this, Vishnu Vardhan, Executive Director, Head Economics and Strategy, Asia and Oceania Treasury, Mizo Bank, joins us live from Singapore. So thank you so much for joining us.
My pleasure. Thanks for having me on for the chat.
So my first question to you, U.S. averts a default as the House passes the debt limit bill. Now my question to you is the limit has been suspended until January 2025. So what's your assessment of this?
Well, I mean, it does convey a very important message that at the end of the day, even if there's brinksmanship that brings it down to the wire, the wider issues of U.S. default are not clear and present dangers. I mean, at the end of the day, we did think that this would be resolved one way or another, whether it comes down to the wire or slightly past. Nonetheless, it does still leave a few things dangling, which is the biggest of which has to be in the near term, the competition for dollar funding. The Treasury needs to, replenish its depleted coffers, and that means that they may have to issue somewhere between 500 to 800 billion worth of T-bills. That's really going to suck out liquidity, which means banks are going to feel a bit of the funding stress, as will, at least U.S. equity markets, if not global equity markets. Further down the road, the question is whether some of that more
Sir, I believe there was a problem with the line there. Now, I just want to also understand what does it mean for the global markets and also the Fed here?
Sure. I mean, and that's a really good question. So for the global markets, what the global markets need to be worried about first is that this huge issuance of T-bills by the US Treasury to replenish their coffers, about 500 to 800 billion, that's going to suck out global dollar liquidity. It's not just a US issue. Economies, banks, and asset markets looking for dollar funding, they will all have to compete with the US Treasury now. And that can lead to two things. One is a much costlier dollar funding rate for everyone. So costs rise in the near term. Sometimes excess is a problem. And risk premium could also rise under current conditions. So that means softer markets, more jittery sentiments, greater volatility. So that's in the very near term. Going further out for the markets, the mopping up of the excess funds that could have been used for spending, so on and so forth, that could lead to a US downturn sooner and a little deeper, also means that exports-dependent economies need to worry about aggregate demand and whether the recovery will take longer. And for most other economies, the question of a global downturn still hangs over them. For the Federal Reserve, they are in a unique position. The imminent clearing of debt ceiling uncertainties mean that given higher inflation prints that have come out, the Federal Reserve has the option of hiking a little further in the near term. But as they go further out and the US economy feels some of this fiscal fade, what might happen is that the Fed would also have enough space to start cutting earlier, because now a shrinkage in the fiscal spending means they need to be less worried about inflation remaining sticky further down the road, say with a 6 to 12 month view of it.
All right. Mr. Varadhan, thank you so much for joining us on this broadcast with your insights on this.
My pleasure. Thanks for having me on.
WION is now available in your country. Download the app now. Get all the news on the move.